I don't know the nominee there for Treasury. I've never met him, so I don't have an opinion one way or the other. Obviously, it's up to President-elect Trump to nominate who he would like, and then for the Senate to consider and confirm those appointees. At the Fed, at the end of the day, no matter who is in these various positions, we know what our job is. We have to get inflation all the way back down to our 2% target, and we have to try to keep the labor market strong, and we're committed to doing that regardless of who's in the executive branch or who's at Treasury.
Given the uncertainty that you're suggesting, is a 25 basis points cut, which is being priced in for December, still the way to go?
It's still a reasonable consideration. Right now, we know that inflation is somewhat above our target. It's running at around a 2.5%, 2.6% run rate right now. I have some confidence that it's gently trending down. And right now, the labor market remains strong. The question in my mind, the biggest question is, where is the neutral rate environment? We've had relatively high interest rates relative to the prior 10 years, and the U.S. economies continue to grow with great resilience, and the labor market has been resilient. And so how do I reconcile the fact that the policy rate has been relatively high and growth has been sustained? That suggests to me that perhaps the neutral rate environment is higher than it was in the past, and that perhaps monetary policy is not putting as much downward pressure on the economy as I would have expected. And so this is what I'm trying to understand right now, is how much downward pressure are we putting on the economy and what is the path for inflation? But right now, knowing what I know today, still considering a 25 basis point cut in December, it's a reasonable debate for us to have.
Why not pause? You talked about how resilient the economy is. You talk about how resilient the labor force is. You talk about how resilient all the factors are. And add to that, we have, this rally in the stock market. Why not just pause?
Well, you're making good points that would argue in favor of not cutting rates. On the other hand, if I look at the underlying components of inflation, goods inflation has fallen all the way back down to pre-pandemic levels. Services inflation is trending down, and that's tied to wage growth, and wage growth is slowly trending down. And what's left is housing inflation. Housing inflation is still high, but if we look at forward leading indicators of where housing inflation is likely going, and that's the inflation of new rents, that new rental inflation has already come back down. So that suggests that housing inflation ought to come back down. Ultimately, we want to get inflation back down to our 2% target. We're not aiming to undershoot it. And so we do have to make some judgments about what is the path ahead for inflation. And that's going to be an important determinant on what we do with monetary policy.
How are you looking at the rally in the stock market? I mean, we've seen a massive pileup in the Trump trade. If this rally continues, do you think it might force the hands of the Fed? Might the Fed be forced to slow down rate cuts?
Well, we know there's a wealth effect through the stock market. People feel wealthier, and then it leads them on the margin to spend more. At the same time, stocks are highly volatile. Stocks can go up with some exuberance, and then they can pull back with just as much force. And so I certainly wouldn't want to overreact to short-term movements in the stock market. At the same time that stocks have rallied, we've also seen bond yields climb. The long yields climb over the last couple months. Now the 10-year Treasury is running at around 4.2 or 4.3%. And trying to understand what's causing those long-term bond yields to climb. One story is markets are pricing in a higher growth environment, perhaps a higher productivity environment. Another possible story is they're pricing in large deficits going forward. I think part of it, maybe it's a little bit of both. And so understanding what's driving those Treasury yields, I think, is also an important factor for us as we think about where is the underlying trajectory of the U.S. economy headed. So the stock market gives us some information. The bond market also gives us important information, as well as all the fundamental data that we look at every day.
Neel, we've been talking about risks to the U.S. economy. I'm just wondering how you're assessing the risks from China. Trump has talked about imposing as much as 60% of tariffs on Chinese exports, and this might just, come back and bite the U.S. economy. How are you assessing that risk?
There's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in from our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path? Reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to. But I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
I'd like to take a look at the future of the Fed. We've heard from Bassett saying that perhaps we should have a shadow Fed chair. What do you make of that proposal?
I saw it. I don't understand it that much about it. And I think more recently he said that he's no longer proposing that. So, I'll leave that to him. I think in America over the last 30 or 40 years has developed a very strong consensus across party lines, Republicans and Democrats, that having a independent central bank focusing on the goals that Congress has assigned us, that stable prices, which we define as 2% inflation, and maximum employment, that if we focus on those goals rather than short-term political incentives, that's better for the U.S. economy on the long run. And I think leaders in both the Republican Party and the Democratic Party agree with that. And that's what gives us confidence that we just need to keep focusing on our jobs. And that's what we're committed to doing.
But is the Fed's independence in question here? Trump has come out to say that he thinks the president should have some say in terms of interest rate outlook as well as monetary policy. And Bassett himself was criticizing the Fed when it moved 50 basis points back in September.
Well, there's actually been a long tradition in America of political leaders expressing their views about monetary policy. Our jobs are to focus on the data and use our best judgment to make the right call that we think based on the data that we see in our analysis of the U.S. economy. And that's what we are going to continue to do. That's what we've done, whether it was President Biden or President Trump or President Obama and all the presidents that came before, at least for the last 30 or 40 years. That's absolutely been true. And I know my colleagues and I are committed to continuing to do that. But of course, politicians on both sides of the aisle are free, like everybody, to express their views on monetary policy. And our jobs are to focus on the data, and that's what we're going to do.
I want to touch on cryptocurrencies. You've been a major critic. In fact, you talked about how cryptocurrencies are like a giant garbage dumpster at one point. I mean, with Bitcoin getting close to $100,000, how are you feeling about cryptocurrencies now?
Well, the question that I've been asking for the last 7 or 8 years continues. What can you actually do with it other than just speculating on it? I understand it's an article of speculation, and that's fine if people want to speculate on it. That's fine. They can speculate on anything they would like. But does it actually have any utility in an advanced economy? Can you buy things with it? Do people buy things with it? At least in the U.S., the answer is a resounding no. Almost nobody buys anything using Bitcoin. Then it was supposed to be an inflation hedge. And then when inflation took off in the U.S., Bitcoin got crushed. So it wasn't an inflation hedge. So it's not a useful payment tool. It's not an inflation hedge. is it merely a speculative asset as an instrument of speculation? If that's all it is, that's fine. People can be free to speculate on whatever they would like. But I would like us to be clear on what this is and what this is not. And I'm waiting for anybody to explain to me how it is actually useful in an advanced economy, and I just haven't seen it yet.
How worried are you, and how worried is the Fed now that institutional investors are more and more getting into the cryptocurrency space?
You know, we pay attention in terms of, like, for example, banks that might be banking in crypto and connecting to the U.S. Federal Reserve and our banking system and the plumbing that moves money around the U.S. economy. So I actually don't care about crypto from a speculative asset perspective. I don't think by itself it presents a financial stability risk, and it certainly is no threat to the dollar. But I do care if financial institutions could run into risk that they don't appreciate, and then that leads to some spillover into the plumbing of the core financial system of the U.S. So that is something we're paying very close attention to. And an example of this would be stable coins, where stable coins are supposed to be pegged 1-for-1 with the dollar, and then they're supposed to take the dollars that people invest and invest in only the very safest assets. But the question is, do we know what they're actually investing in? Are they actually investing in the safest assets, or are they reaching for yield? In which case they end up looking a lot more like a bank than a stable coin. And there's a reason that there's regulations around banks and conditions and controls around banks. So there's a lot of potential for abuse or confusion around some of these, and that's why we do have to pay attention from a financial stability risk. But just in terms of the volatility of Bitcoin moving up or moving down, you know, that's not something I pay much attention to.